Hello, and welcome to the Small Business Advocacy Team's Capital Call, our take on a public company's earnings release call. We're excited to be here with you, our shareholders. Today, we'll be discussing capital raising data from the past year, including how capital raising trends intersect with public policy. Following the presentation, we will be taking live Q&A, and we look forward to hearing your perspectives. To ask questions live, you must be registered and attending through our platform so you can see the chat window to the right of the video feed. I'm Stacey Bowers, the new director of the SEC's Small Business Advocacy Office. I joined the team just 2 weeks ago, and I'm so grateful for this opportunity. I've been working with startups throughout my career, so I know that capital raising is both rewarding and challenging. I most recently worked as a professor and served as the director of the Corporate and Commercial Law program at the University of Denver Sturm College of Law, where I taught classes in capital raising and accounting for lawyers. I also have been actively practicing law, representing entrepreneurs as they sought to raise capital for their businesses, ranging from startups to those more established. I am honored for the opportunity to now serve in this important role at the SEC, and I am eager to engage with small businesses, their investors, and support diverse organizations from across the country. I look forward to hearing your perspectives on how our office can best advocate for you. As a cool aside, I wanted to share that in my law professor role, I was regularly using the SEC's 2022 annual report in my capital raising class. What a truly amazing resource. I'm a big fan of the Small Business Advocacy's team's great outreach initiatives and work on educational materials, as well as their beautiful and comprehensive annual reports. In a moment, I will turn the stage over to Amy Reischauer and Jenny Riegel, two leaders of the team whose passion and hard work on the fiscal year 2023 annual report will shine through as they dive into discussing the top challenges in small business capital formation, the data behind those challenges, and the office's recommendations to address them. I look forward to coming back on screen to moderate audience Q&A at the end. Before I turn it over, I want to emphasize that our advocacy team is here to listen, share resources, and do whatever we can to help small businesses and their investors navigate the capital raising landscape. Please continue to join us at events like this one, or email us directly at smallbusiness@sec.gov. With that, thanks again for being here today, and now I'll turn it over to Amy and Jenny.
Thanks, Stacey, and welcome to the team. As Stacey mentioned, we're going to explore some of the top capital raising challenges that we're hearing across the small business landscape. We'll show what the data is showing, and we'll talk about our office's policy recommendations. Each recommendation is based on what we've learned throughout the year through our public engagement and from monitoring the data on capital raising trends. So we'll save time at the end for that Q&A that Stacey talked about, so don't forget to drop those questions in the chat. With that, let's turn to the first challenge. To set the stage for this first and really all of the challenges that we're going to discuss today, I want to start with a basic idea that small businesses are key to our economy. And that's true both in what they do in the present, providing jobs, goods and services, infrastructure, and in the important role that they play in shaping the future. Even the largest of today's public companies started as a small business at some point. While all businesses need capital to create those jobs, to grow, to innovate, many founders and small businesses struggle to access that capital. So as you can see here, the importance of small business has been reflected in the data year after year. Over 43% of US GDP. That's almost half of everything the economy produced in 2022. That was attributable to small businesses, as were about 63% of net new jobs from 1995 to 2021. However, an increasing percentage of small businesses continue to experience financial challenges. Challenges like accessing capital are top of mind for most small business owners. And among those small businesses, the playing field isn't even. Entrepreneurs of color are less likely to receive the funding that they seek from loans, lines of credit, other sources like that. A lack of access to financial resources is particularly problematic for some entrepreneurs of color. They cite it as the primary reason that they stop pursuing their small business. Women founders similarly face an uneven playing field when seeking access to capital. So what can we do? What can we do? What can we do to address this challenge? One thing we can do is to help ensure that founders and their investors have the access to the kinds of tools that they need to understand and to navigate the complexities of capital raising. They need accessible tools and educational resources to understand and comply with our securities laws. A large part of what our team does is to engage with folks throughout the small business ecosystem, entrepreneurs, small businesses, investors, and other thought leaders around the country. We do that virtually and in person. We want to hear from folks with boots on the ground about what they're experiencing, what's working, where the challenge is coming. In fiscal year 2023, we hosted or participated in over 30 different events. Those events focused on issues like the unique obstacles facing women and diverse entrepreneurs, the importance of building and gaining access to networks, and how to increase diversity among capital allocators, those decision makers, and then the impact of that diversification on the funding of women and diverse founders. In our efforts to respond to calls for accessible tools and feedback from users who've explored our resources, we've continued to update and expand the tools available on our capital raising hub. Based on analytics that we've been tracking, we're thrilled to see that folks are finding and clicking through to those resources. Over 63,000 users visited the capital raising hub in FY23, and over 255,000 found our tools and resources. That is great. That is great news to us. But of course, we'd love to keep sharing them further. We want to get them in the hands of folks who need them, folks who can use them. So please feel free to check them out, share them with others in your network, and let us know what you think. That feedback is so important to us because it helps us provide you with better support. Now I'll invite Jenny to hop on to talk about another challenge that we're hearing about.
Thanks, Amy. As you've heard already, raising capital is challenging and access to capital is limited. These challenges are often heightened for women and diverse founders, where existing inequalities have ripple effects, and for founders located outside of traditional capital raising hubs. Access to capital has become more difficult in recent years. The majority of small business owners found it harder to raise capital last year than in prior years. When more startups aren't able to find financing, they struggle to survive, and eventually they need to close their doors. As Amy noted earlier, many of those challenges are heightened for women and diverse founders. On the plus side, we did see an uptick in angel financing for women founders. But later stage businesses seeking VC capital were not so fortunate. Only a tiny slice, 2% of VC funding, went to women founders. And of that tiny slice, Latina and Black women founders only saw a small fraction, 5% of that 2%. Disparities in income affect the ability of entrepreneurs of color to grow personal wealth and self-fund a business. Here, for net worth, we see similar disparities. Given these ripple effects, it is not surprising that founders of color faced outside challenges in securing VC investments. We see similar challenges for rural businesses and those outside of traditional capital raising hubs, where compared to their impact on the economy, their share of capital raised fell short. Now, something we've seen consistently in the data and here through our outreach is that diversifying capital allocators and decision makers facilitates greater funding of diverse founders. Data shows that diverse investors are more likely to invest in diverse founders. However, we're seeing an increase in women and diverse investors, but they remain underrepresented. Here, you see women make up only 40% of angel investors, and less than 1 in 10 angel investors were racially or ethnically diverse. So what can be done? How can we address this challenge? There are a number of targeted regulatory changes that would promote inclusivity and equity in the entrepreneurial ecosystem and improve the capital raising process. First, looking at the accredited investor definition, we recommend
that the Commission expand the accredited investor definition to include additional qualitative professional criteria and offer more opportunities to demonstrate financial sophistication as an alternative to the wealth thresholds. We further recommend that in connection with any action it takes in this area, the Commission consider the impact of any change to income and net worth thresholds on diverse founders and investors, as well as those located in rural areas. Any review of the definition should expressly include a review of data on household income and net worth by race and ethnicity, and by geographic location. Raising the wealth thresholds would have a disparate impact on diverse founders and investors, and geographic areas with a lower cost of living, including rural areas. Now, before moving on to the next targeted recommendation, I'd like to touch on another fundamental premise as we talk about capital raising, and that is every company needs capital to build, grow, and scale. For many growth stage companies, raising capital through the private markets is a necessary step in their life cycle. For the millions of small businesses that are not looking to become public companies, funding is critical to their development and for job creation. For future public companies, early stage and VC funding can be instrumental in growing the business to the size and maturity needed to go public. While the percentage of IPO companies with VC backing has varied, the link between VC backing and preparation for an IPO remains. While still concentrated in traditional urban hubs, VCs are funding growth startups across the country. Those VCs primarily rely on Rule 506 of Regulation D to raise money from sophisticated investors across the country. This slide illustrates the capital flowing into the exempt or private market, which is in blue, and the registered market, which is in gray. As you see here, like in prior years, Regulation D is the most frequently used pathway in the exempt market to raise capital from investors. But that bubble graph isn't the end of the story. And looking at the size of the private and public markets, we need to consider how those numbers break down. For example, if you look at the $2.9 trillion raised under Regulation D, operating companies raise less than $300 billion, or about 10%. Pooled funds raise the other 90%. On the public company side, companies raised about $1.1 trillion in registered offerings, and the amount that flowed into registered funds was $8.8 trillion. So again, close to that 90-10 split. So now let's look at how U.S. companies are raising capital. Here, the data shows that registered offerings account for the majority of capital raised by companies. Regulation D is still a decent slice of this pie, but it's dwarfed by the amounts raised in public offerings. For those curious, other exempt offerings here reflects offshore offerings under Regulation S and offerings under Rule 144A, which is a resale offering after a private offering. So drilling down one more step and looking just at private companies, the vast majority of deals by count are under Regulation D, and specifically Rule 506B. Now in the graph, it's that point that you see in the line graph. But when you look at the dollar amount, 506B continues to be considerable, but more capital is raised under those other exempt offerings that we discussed. So based on feedback from businesses and investors about their use of Regulation D, we urge caution on potential changes. We particularly encourage the Commission to not make the Form D notice and disclosure requirements more burdensome, especially for small businesses raising a small amount of capital. As you know, diverse founders and founders located outside the typical capital raising hubs are often overlooked by traditional funding sources. Crowdfunding, however, has seen some encouraging trends. crowdfunding involves smaller offerings with smaller checks from investors that don't need to be accredited. Most companies launching crowdfunding offerings are succeeding in raising their minimum targets. Many founders of color, women founders, and founders located outside the traditional capital hubs are finding funding opportunities through regulation crowdfunding. While regulation crowdfunding has become more widely used, only a small fraction of capital is raised under it. We recommend that Congress or the Commission amend the rules first to allow flexibility in the type of accounting a company uses for small businesses raising up to $500,000. Second, to increase the offering size threshold that permits certified financial statements and income tax return information. And third, to amend the Securities Act to modify the prohibition against investment companies using regulation crowdfunding. And with that, I'll pass the mic back to Amy. Amy?
Thanks, Jenny. Let's turn to another challenge we're hearing about, and that's making connections and accessing networks. To build successful companies, startups need savvy investors. And those investors bring not only financial support, but industry experience, customer connections, strategic guidance. And that kind of support can have a significant positive impact on a business's trajectory. However, sophisticated early-stage investors with deep pockets and the right risk tolerance, like professional angels or venture capitalists, are often outside the social and geographic networks of many founders. Resources, knowledge, and connections are critical, but the data shows that 70% of startups report financial challenges. Over 3/4 of them report challenges finding support and resources, and 22% struggle to find advice or role models. Lack of access to professional support is a barrier for all entrepreneurs, as we just saw, but particularly for entrepreneurs of color, as you can see here on this slide. Women also report with challenges and seek supportive entrepreneurial communities and connections. These challenges are similarly magnified for founders outside of the traditional capital raising hubs. While investors are looking farther from home, founders in small markets and rural entrepreneurs face an added barrier reaching investor networks. Making those connections is critical. So what can be done? Well, registered broker-dealers can provide matchmaking services, but they tend to do so primarily for larger offerings. As a result, many early-stage startups are excluded from that investor matchmaking process because of the size of their offerings. Since our very first annual report in 2019, our office has been advocating for regulatory clarity on the role of finders in facilitating introductions between founders and investors. We hear frequently that the lack of regulatory clarity in this area harms both investors and the companies those investors are seeking to support. The lack of a clear framework makes it easier for unscrupulous intermediaries to solicit investors without disclosing important information about conflicts of interest. Then, if an intermediary does engage in unregistered broker-dealer activity, it could expose the company to rescission rights, and that would require the company to return the investor's investment plus interest. We continue to support calls for additional regulatory clarity for finders, and we recommend that Congress or the Commission take action in this area. Jenny?
Thanks, Amy. Founders seeking funding beyond friends and family or angel investors often turn to private funds. But as markets have tightened, investors are allocating more capital to larger, later-stage funds and less to small and emerging fund managers. Those emerging fund managers are the ones who tend to invest smaller checks in earlier deals and also tend to allocate more to women and diverse entrepreneurs. So less capital feeding into the smaller VC funds means less VC backing for women and diverse-owned businesses. And as we've seen, the value of that VC backing extends beyond the check itself. Here, we see the considerable drop in overall fundraising, and that drop continued to concentrate in large and established funds. Given the data on the slide, it's not surprising that emerging fund managers overwhelmingly reported difficulties in fundraising. Despite this difficulty, emerging fund managers accounted for the majority of capital raised by funds outside the traditional venture hubs. Women and diverse fund managers face challenges in accessing capital. These challenges are even more acute for Black and Hispanic women-owned fund managers. As you see here, those groups raised less in the aggregate and saw a much lower median fund size. The ability of diverse fund managers to access capital has a tremendous impact on the funding of early-stage businesses. Most Black and Hispanic investment partners are in firms that focus on seed and early stages. Despite an increased focus on diversity, equity, and inclusion, the enthusiasm that rose in 2020 for investing in diverse-founded companies has waned. In addition, we hear from market participants that recent litigation over funds' use of diversity criteria may continue to curb that enthusiasm. Women and investors of color are more likely to invest not just at early rounds, but specifically in businesses with diverse founders. Diversifying capital allocators and ensuring those allocators have access to capital has a considerable impact on funding diverse businesses. Given this data, it's likely not a surprise that as VC funding has dropped, the share of capital received by women founders remains a small fraction of a smaller pie. Here, you see the significant difference in deal count and size. Hispanic and Black founders also saw a disproportionately larger decline in their share of VC investments. Our office continues to hear calls to support emerging fund managers, and we reaffirm our recommendation for steps the Commission and Congress can do to do that. We recommend that the Commission amend the Venture Capital Fund definition in the Investment Advisors Act Rule 203 to include fund of funds investments as qualifying investments that would be excluded from the 20% non-qualifying basket. For those wondering what fund of fund investments are, they are investments by venture capital funds into other, often smaller venture capital funds. Essentially, this would permit larger funds to invest in smaller funds managed by emerging managers that can allocate those funds in smaller checks. This change could potentially unlock more capital for diverse and early stage businesses. We also recommend that Congress amend the exemption in Section 3C1 of the Investment Company Act to increase the limit on the number of beneficial owners. The current beneficial owner limit often makes it difficult for emerging fund managers to raise a sufficient amount of capital. Finally, we recommend that Congress further amend Section 3C1 to increase the 250 investor limit and the $10 million maximum fund size for a qualifying venture capital fund. Raising those limits would equip emerging managers to raise a meaningful sized fund while covering their expenses. We've got one more challenge that we'd like to talk about before getting to your questions. But before Amy comes back, please remember to chat in those questions. Amy?
Thanks, Jenny. Yes, absolutely. Bring on those questions or drop a comment in the chat. We'd love to hear from you. Meanwhile, let's talk about our public markets and how small companies are faring. After an active market in 2021, 2022 and 23 saw significant declines in the number of IPOs across the board. The number of smaller companies going and remaining public continued its long-standing decline. Yet the impact of smaller companies on our public markets is critical to the vitality of those markets. Over the last several decades, small companies accounted for the vast majority of the decline in the number of exchange-listed companies. Small companies dropped from the 4,000s to around 1,000, as you can see on the chart here, while the number of large exchange-listed companies has grown from a little less than 1,000 to over 2,500. Aggregate market cap shows an even starker comparison. While the aggregate market cap of all public companies has grown exponentially from 1.7 trillion in the early 80s to 43.6 trillion last June. Meanwhile, small public companies' share of that growth has seen a far different trend, crashing from about 230 billion to 120 billion over the same period. In dollars, that's about half. But if you look at it from the perspective of the share of the aggregate, as this slide shows, that's a drop from over 13% to less than 0.3%. So a combination of factors has contributed to these IPO fluctuations, including that significant decline in the number of IPOs. But let's look specifically at small public companies against the overall backdrop. Small company IPOs have remained a relatively stable and consistently small fraction of the IPO market. Small companies that do go public often see their stock prices suffer following their IPO. So the costs of going public garner lots of attention, but the costs to operate as a public company may be even higher. Being a public company means complying with SEC regulatory requirements, and that compliance often involves fixed costs that aren't scalable for small companies. And some of those costs have disproportionately increased for smaller reporting companies. Beyond compliance costs and disclosure, small public companies receive less research coverage than larger ones, despite their efforts to increase that coverage and to target new investors. As I noted earlier, the vibrancy of our capital markets depends on having companies of varying sizes, from microcap to megacap. That's what provides investors with meaningful options to diversify their investments, a hallmark of our public markets. In developing rules, the Commission should be mindful of whether those rules, including their compliance costs, promote an environment that fosters small public companies not only going, but remaining public. If not, we will continue to see a declining number of small public companies, and that translates into fewer investment choices for investors. Aligning the definitions of smaller reporting company and non-accredited filer would complement the Commission's previous efforts to scale disclosure requirements for small public companies. It would also help simplify a complex landscape of rules and ease regulatory burdens on smaller companies. This could encourage more small companies to go public and make it easier for them to remain public. Scaling disclosure obligations helps to balance the costs and benefits of the rules, particularly the higher proportional impact of fixed costs on the small public companies. Delaying compliance for small public companies helps to promote better initial disclosure for those companies, because the small companies could benefit from seeing the disclosure that the larger companies prepare in response to similar new requirements. So now that we've walked through these 5 challenges and our office's recommendations, I'm going to invite Stacy back on the screen to help us get to those questions.
Thank you, Amy and Jenny. What a wonderful presentation. There's so much more in our annual report, and I encourage you to download a copy if you haven't already done so. Now, we welcome questions from the audience. Just as a reminder, please type your questions in the chat. And as I mentioned at the start, to ask questions live, you must be registered and attending through our platform, so you can see the chat window to the right of this video feed. If you are watching from the Capital Call page on sec.gov, you still have time to register through the link on the right to access the platform and the chat functions. And if you are attending through our platform, you can also access our poll right below on the right-hand side of the blue box. Please take a minute to share a little bit about yourself and your capital raising experience. And one last plug, if you're on the platform, you'll see the feedback tab on the left. Tell us how we're doing and share your thoughts. Now, let's turn to our first question. Jorge wrote in with his registration to ask a question that we are always happy to get since we love to hear from all of you. What is the next step to engage with the SEC on topics up for discussion? And I'm going to happily take this first question, Jenny and Amy. So we encourage you to comment on active rulemaking. If you need insight on that process, check out our office's video on how to comment. It's located on our capital raising page. Please know that even a short comment is useful in the rulemaking process. You can also attend events like this one, ask us questions, provide information in the poll at our links, or provide us with feedback. You can find information about our upcoming events on our homepage. sec.gov/OASB. And additionally, if you have a specific question, you can email us at smallbusiness@sec.gov, and we can route your question to the right staff person. All right, let's see what's come in through the chat. Our second question is from Jean. And Jean asked about the accredited investor definition policy and wanted to know how potential changes to the definition may impact flow of funding. Jenny, did you want to take this one?
Absolutely. Thank you so much, Stacy. So I think the easiest, and excuse me, the easiest way to do this is if I could share my screen, and I think I'm going to help walk you through. So this is Jean, you are spot on to raise this as an issue, and I want to just directly show you how you can get to our resources. And so if you go to our hub, so the way you get here is either sec.gov/capital raising, or if you go to sec.gov under the education tab, you can go under small business capital raising, and it will take you to this page. So in the rulemaking video gallery, you can click here, and it takes you to that how to comment that Stacy had mentioned. And this will talk you through how to do a comment. And as Stacy mentioned, you can essentially go and watch the video and learn. It can be as simple as a tweet. It could be people have done screenshots. It doesn't have to be a letter written by a lawyer. And that's one really important thing. But the other thing I wanted to flag is the accredited investor Dodd-Frank review video. And this video walks through a little bit of what I think Jean was talking about in their comment. And what it does is it walks through kind of what the definition is and where the commission is at. So we encourage you to go take a look and share your feedback with us. In addition, I want to just show some of the other resources that we have on accredited investor. So one that comes to mind is our building blocks. And these are kind of like our one-pagers that talk through what the definition is and kind of gives you the basics. So this building block as an individual, the financial criteria, the professional criteria, and then the way to qualify as an entity. And one other thing that I wanted to highlight before I turn it back to Stacy is the glossary. And so one of the really cool things about our glossary is it walks through all our resources. So I'm going to go to A for accredited investor. I had shown before, but it also talks about any other resources that also link related to that definition. So you can get a quick and easy definition, whether it's a term like accredited investor that relates to capital raising, or whether it's a term that relates to just the market terms for raising capital. And so these kind of help walk you through, different types of things that may come up that may be helpful to you. With that, let me turn it back to Stacy.
Thanks, Jenny, for sharing all that information and showing people where to find the great resources on our website. The next question came in through our smallbusiness@sec.gov email, and it's from Michael with Mike's Flooring and Painting, and he wanted to know how to get underway as a startup.
I'm happy to jump in and give Jenny a break, get a glass of water there. So like Jenny, it's another great opportunity to point out that we have kind of a number of resources. So now I think we're really taking a step back. We're looking at that early stage startup, just thinking about funding. And there's so many funding options, many of which have nothing to do with the SEC. So you really want to kind of think about where you're starting from, what you have going for you, what are your options? And there are just kind of a number of them to navigate. So I'm going to hop on and share my screen to point out a couple of other resources that might kind of help us think through, really, where do you start? Like fresh from the starting line, where does one go? So here I am at sec.gov, like Jenny said, go to the education tab to our capital raising hub. And now the first thing I'm going to show you is our funding roadmap. Let's see how quickly I can get it to pull up on a busy day with lots of viewers on our website. This is, it's kind of a fun graphic, but the point is to show that there are so many funding options. Some businesses are funding it out of, their founders' pockets, or maybe they have revenues from the business already. But if you don't have that internal capital, folks are going to start looking to external sources. Most people are going to want to start with external sources that are like grants or loans, something we call non-dilutive capital. This is a source of funds. In the case of the grant, you're not even paying it back. In the sense of a loan, you may have to pay that back with interest. But in either case, you're still retaining the ownership of your business. So that's what we call that non-dilutive, because it's not going to dilute your ownership of the business. Then there are folks, for whatever reason, whether maybe those, as you've seen in the data, those resources aren't available to all entrepreneurs. So if you're in a situation where those resources aren't available, or maybe you're a little later stage and you think you're really ready to take on investors, then you may be looking at capital from investors. But to put this in perspective, of the folks who are looking at external funding options, so we've moved past the self-fund, we're into external funding options, only 6% of those businesses turn to investors. So it's a pretty tiny slice of the pie. But once you hit that slice of the pie, that's when the SEC, folks like us, and our rules are going to apply. And so that's when we want to make sure that you're aware of that you know what those rules are, that you're ready for that environment, that you're really ready to take on those kinds of investors. So one other thing I was going to share. So if you're at that point, you've rounded the bend on that funding roadmap, and you think you want to kind of gauge if you're ready to take on investors, I'm going to take us back to another one of the building blocks. I know Jenny showed us one on accredited investor. I'm going to show us a little bit earlier stage, a little more fundamental resource. We have one about, hey, how do I know when I'm ready to raise capital for investors? And we have our cute little acronym. We say capital. But this is really just kind of a list of issues you might want to consider, some steps you may want to take, questions you might want to ask yourself to really gauge if you're ready to take on those investors and what kind of things you need to have lined up. So C, we've got capital. You're going to want your cap table and your financials lined up. If you're going to take on an investor, they're going to want to know who owns you, what do your books look like. That's going to be an investment of time and resources to get that step ready. You're going to want to know the amount needed. I seem silly, but you really need to understand how much you need and why you need that much. How long is that going to last you? What are you going to do with it? Perfect segue to the P, the plan for proceeds. If I say I'm going to need $200,000, I should know why I need that $200,000, because my investors sure are going to want to know why I need that, that amount and what I'm going to do with it. The other thing, moving on to this investor strategy, another thing you've heard us talk about today quite a bit is that investors often bring more than just a check. Founders should really think about what are they bringing on when they bring on those investors. What more than the check do they want? Maybe it's connections in the industry. Maybe it's experience with the technology that you're using. Maybe it's just guidance because they've been through the startup process before. But that's really critical, and they can bring a lot of value. Getting to the T, time and resources. If folks on the call who have tried to raise money and tried to start a small business, that capital raising can be like a whole second full-time job that you need to understand you're going to devote those kind of time and resources to. A, advisors, line up those, attorneys, accountants, folks who can help you along the way. And then finally, L is this long-term vision. It's just the idea that you want to have your kind of ducks lined up in advance. You want to know what your long-term strategy is. You're going to want to know what kind of exit strategy you could plan for your investors, because while they you want them and they want to invest in you, they don't necessarily want to give you their money forever. So you want to give them a horizon, a sort of a future picture of what you expect. So anyway, a little bit of guidance on where we should start to answer Mike's question. I'm going to stop sharing my screen and then turn it back to Stacy.
Thanks for that great explanation, Amy. That was really helpful. And I really want to encourage everyone who's here with us today to take advantage of the resources we have. I'm sorry, Jenny, I think I cut you off.
No, not a problem. I think the only other thing, and I have to say, it is my favorite tool that I was thinking of. And so I wanted to see if I could share my screen, and I could walk you through. Just I have to mention it because it is one of my favorite resources to share. The Navigate Your Options. It's kind of your choose your own pathway. If you're not sure, if you want to raise capital and you're not sure what type of capital you want to raise or from whom, it helps provide resources. So for example, for Mike, if his business doesn't already exist, you could click no, and it will give you all of those SBA resources. Those are also linked in that roadmap that Amy had highlighted earlier. Same talking about that external capital, and gives you a number of links to get there. But as you go through the pathway, it will also highlight a number of just different investment options that you may want to think about, and kind of it highlights the potential ways to raise capital, right? So I'm just more relevant based on those choices. So I think it's just something like a fun tool that highlights the different securities law options if you are seeking to raise capital from investors. Sorry, Stacey, I just, I get excited about our tools.
No, I think that's fantastic. Thanks, Jenny. Thanks for sharing that with everyone. So we have another question that came in via email, and it's from John, who's from Johnson City, Tennessee. And they ask, as a founder of an early stage startup, he noted the regulatory burdens for financially challenged small businesses seeking capital formation. He wanted to know the status of the SEC's proposed finder's order, and Linda also raised the finders via the chat. Jenny, can I turn it back to you for this one?
Absolutely. So to step back, because I think sometimes it's helpful to have a little bit of context and background for those who may not be as well versed as John or Linda on this. So in October of 2020, the Commission proposed a limited conditional exemption. And this is an exemption from the broker registration requirements for people who are known as, quote, finders. But what are finders? So finders are people who assist issuers with raising capital in the private markets. They try to help build those connections. And that goes to one of the challenges that Amy highlighted earlier on making connections and accessing networks is something that we are frequently hearing about and raising in our office. In fact, actually, this is something that we've raised since our first annual report in 2019 and every year after. We have been advocating for regulatory clarity on the role of finders in facilitating these introductions between the founders and investors. The Commission has not finalized a proposal. It is not in the list of upcoming regulatory actions, what's known as called the Reg Flex agenda, which sets forth kind of what the Commission plans to achieve in the next year. So it is not clear when or if the Commission will finalize this. We do know this continues to be a challenge. And John and Linda, thank you for reaching in and sharing this feedback. We really appreciate it and value it. And we know this continues to be a challenge. We welcome continued engagement on this topic and happy to set up a call to talk about this and hear more about the challenges specifically and, if there's anything our office can do to assist.
Great. Thanks, Jenny. And I think this is going to be our last question for the day, and I'm going to kick this one over to Amy. So another question that came in via email was whether there was an application or a test that a person could take to become accredited.
Absolutely. And I know Jenny already shared our resources on this, but so you'll find what is the actual definition of an accredited investor. But that said, one of the reasons we put these resources out is because this is, like many areas of capital raising, this is a frequent area of confusion. When you hear accredited investor, that sounds like, an accreditation or a certificate. And so an accredited investor is not someone who applies to the Commission. The Commission doesn't weigh in to say someone is an accredited investor. Commission rules define what an accredited investor is, again, for an individual based on net worth or income or certain professional criteria, not a certificate or an application through the SEC, and also not a test that you can take somewhere to. There's a test involved to reach one of the professional criteria that are approved, but there's not like an SEC test that you take to become an accredited investor. That said, people have talked about that when we talk about ideas that are out there for the accredited investor. So there's a lot of discussion in this space, which I think also adds to the confusion because you're not really sure, hey, are we talking about this as an idea or is this actually how you become an accredited investor? So the accredited investor definition is limited to that, again, for the individual, that net worth income or the very specific FINRA licenses at this point. And then for an entity, it's different, but it depends on the structure of the entity and generally kind of the assets or investments held by that entity. Again, all of that is set forth in the building block that Jenny referenced, as well as the definition in our glossary. So again, I encourage you to take a look at those. Again, we're always striving to minimize the confusion caused by the complexity of our rules. And also, I'll use it as another plug. If some of those ideas that you've heard floating around, if you think they're fabulous, if you think they're terrible, if you have a new idea, if you want to give us feedback on how it's working, use some of those pathways that Stacy told us about. Reach out to the staff, reach out to, find relevant comment files on active rulemaking, show up at events and, put us on the spot and ask us questions here because these are the conversations we really want to be having with all of you. So thanks for the question.
Thanks, Amy. And I'm going to throw both Amy and Jenny off and say, let's take one more question because I think it's an important one. And I'll let both of you maybe weigh in or choose who wants to weigh in. But Dante in the chat raised the issue about the lack of capital access for Black-owned businesses. Any thoughts?
Absolutely. I'll give Amy a break in speaking and dive in first, but this is something we hear repeatedly, and you probably saw it as a trend in our presentation. And this is something that we're personally passionate about. And as an office, it's part of our mission. It is part of what we do. And it is something that we think about constantly. So we welcome thoughts on kind of ways to improve. Our office's recommendations sought to try to adjust some of those challenges, but we welcome feedback. Did we strike the right balance? Are we missing the point? Another thing that we do is, in addition to all of our speaking engagements, and we go out and we hear this feedback and talk to businesses all across the United States, we also look at the data. And that is one thing that you probably saw on the slide. So we highlighted, I'm personally in love with data. I think it really speaks to what's happening in the market. And it really drives kind of the force behind our office and kind of matching what we're hearing in those stories and those powerful, challenges and hurdles and successes, but also seeing what the data is showing us and kind of how can we think about that. And we provide all of this information to the commission. We frequently work with the rule writers and try and highlight these challenges so they're aware, right? We need to not only step back and think about what is happening with the market at large, but we need to understand how it's impacting diverse businesses and women and, entrepreneurs who are in those rural areas that, often aren't getting the limelight of the Wall Street Journal, right? And so we want to really step back and think about this. So Dante, I really appreciate you raising it and flagging it. If you have thoughts on how we can improve and how we can do better, we welcome. Please reach out. We have a team of lawyers small team, small, mighty, but do respond to all of those small business emails. So please reach out, share your thoughts, your ideas. We'll set up a call and we can talk it through. Amy, I know I just talked way too long, but let me turn it to you.
No, I would really reiterate kind of everything Jenny was saying. So, we monitor the data. If you're seeing, if you get through our annual report, we love it. We work really hard on it. We try and include the data, but if you see something missing, if you see a source, if you're with a group that has a report that you do and you think, it was great, you showed A, B, C, and D, but you missed F, let us know. Come to our events, come to the gatherings when we're soliciting feedback. In addition to that broad data, the anecdotal data helps too. Tell us your story. Let us hear how it's affecting the people who are out there. Again, that whole boots on the ground, you hear me say a lot. And people who've heard me talk will know that I am always like thrilled to get the feedback. Tell us how to do a better job. Tell us what we're missing. Because these are hard questions. And we admit we don't have the answers. And we're hoping that, folks, founders, investors, folks in the small business world can work with us to help us find them. So what she said, I guess.
Well, thank you, Amy and Jenny. First of all, thank you for an amazing coverage of the annual report and your thoughtful responses to the questions. And I think with that, we're going to mostly wrap it up for the day. I just want to say on behalf of the SEC's Small Business Advocacy team, thanks to all of you for joining us today. I hope you enjoyed the presentation, and I hope you feel like you walked away with some useful information. As we learn from the data and hear from each of you, entrepreneurs and small businesses, we know that mentorship is crucial to success. And with that in mind, I'm going to do another plug. Our office is holding a panel discussion next Tuesday at 1 p.m. Eastern Time with individuals from a variety of entrepreneurial organizations. We really encourage you to sign up and register for that event, and you can find the information on our website. And then just as a final reminder, check out all of those resources that Jenny and Amy were highlighting. You can find them at sec.gov/capital raising, and then reach out to us. You can email us at smallbusiness@sec.gov. And again, thanks so much for being here and have a great day. That's a wrap on our 2023 Capital Call.